Hey, Archie, I would really like to give more money to my church and my favorite charities, but I'm not really sure that I'm getting much tax benefit from it.
Well, Rob, let's give that some thought. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast, sponsored by Hoxton Planning and Management. We're your hosts, certified financial planners Archie Hoxton and Rob Hoxton. And today, we've got an interesting topic, especially for those of you who like to do some charitable giving. We're talking about different giving strategies, different ways to give money or property that are, advantageous for different situations and different kinds of taxpayers.
Archie, this is one of the things that I love most about the work that we do. We work with families and individuals as they plan for retirement, but a big part is also, how can they support the causes that are really important to them?
Right.
And when you help people do that, you can see the excitement. If they've been really good savers and investors and they have a little bit of extra and they want to make a difference, helping them figure out how to make that difference, create a legacy or something that lasts and is more durable than they are, there's a ton of joy that comes with that. So I love this topic. I'm really excited that we're going to talk about this today.
Yeah. Well, and a lot of the time, you've got sort of a general idea that if you give to charity, you'll save money on taxes, but it's not always straightforward and simple like that. And so for a lot of people, the idea that entices them is, well, I like giving to charity a lot more than I like paying taxes. I don't mind paying my fair share, but if I can give a little bit more to the causes that are really important to me, I'm going to be happy. But there are ways to give and still pay as much in taxes as you normally would have. And so we want to try to avoid that. So there's more money in your pocket to give more to the charities that are important to you.
Right. Yeah.
While still paying your fair share.
A few years ago, the tax laws changed, and it really had a profound impact on the ability of our favorite charities to raise funds, right? Because when the standard deduction basically doubled, which incidentally for singles, it's $14,600. For married couples, it's $29,000 who are filing jointly, it's $29,200. So unless you're itemizing and those deductions are greater than the standard deduction, then you just do the easy tax return and take the standard deduction.
Right.
And I think, just in the volunteer work that we do, and we're always asked to be on the finance committee for every charity or to be a fundraiser, when actually I might actually be more interested in working in the soup kitchen. But we have seen that in the years since that happened, it's been about 6 years, it's really been tough on charities because people don't feel like they can get a tax benefit from giving anymore. And that's not necessarily true.
Yeah, it's all about knowing how to give and making sure that, and there are ways, you may find that you're in a situation where you just plain don't get the same tax benefit, but you can get some tax benefit potentially. And we'll get into this. We want to break this down by different types of gifts and different ways that people give money. First few will be the most common, and then there'll be some others in there that are maybe a little bit more niche and don't apply to as many people.
Is that niche or niche?
I mean, do you say quiche or kitsch?
Oh, that's true. Good point.
That's how I think of it.
All right.
So the first kind of donation is sort of like what comes to mind for everybody is just a cash donation.
Write a check.
Yep. Money order or, literally cash in an envelope to your charity of choice. And this is sort of the simplest kind. And really, this is the kind that this new tax law with the change in the standard deduction, this is the kind of gift that was most affected. And it was also probably the most common method of giving. And so, it used to be when the standard deduction was much lower, if you're, if you've got a mortgage, if you're doing donations, if you've got maybe advisory fees, you can get all your receipts
Those are all
together.
deductible expenses.
Right.
You bundle them all up, and that would be over the standard deduction. So you'd itemize and get a tax deduction. Is that what?
Right.
Yeah.
So every additional dollar that you donate was, you're saving 24 cents on the dollar or whatever it was that your tax bracket was. That's not the case anymore now, unless you're giving and mortgage interest, state and local taxes, all that
Medical
kind of stuff.
expenses.
Yeah. For some people, medical expenses are still deductible, but unless that exceeded, if you're married, $29,200 total for the year, then you don't get the deduction on the charitable donations.
So to be clear, I mean, you may, if you're taking the standard deduction and you give a cash donation, you may not get a tax benefit. But hey, getting the tax benefit really isn't the only reason why people give to charity. Really, the reason people give to charity is because they care about that charity. And I believe that the real benefit of that donation is received not by the charity, but by the giver. Right? It just does something for you that is non-financial. It just makes you feel good. It makes you a better person, maybe, but it's not just about the taxes.
Right. Yeah, exactly. That's a good point to make. So it is important, to look at it from that, and not, because at the end of the day, if the only reason you're giving money is to save money on taxes, well, you're out more money. If you give $10 to charity and you save, $3 on taxes, well, you're still out $10.
It's not a tax credit.
Yeah.
It's a tax deduction.
Right.
Yeah.
So the taxes are really a secondary benefit.
So maybe if you're taking the standard deduction, maybe the best way to do this is not with a cash donation.
Yeah, that's probably not. There are better ways. It depends on your situation, but there are better ways and a better kind of tax benefit that you can get.
What's one of them?
So, well, let's talk about one of them. Is another very common way to donate to charity, which is to donate securities directly. And most commonly, what you'll see is two things: either someone actually giving some security, and when I say securities, we're talking about stocks, bonds, mutual funds, exchange traded funds, that kind of thing. They'll actually donate the shares, and it'll be the shares themselves will be deposited in the charity's operating account. And what happens, the tax benefit from that is that it really applies if you have a gain on the security, if it's grown since you purchased it. Normally, if you want to sell that security, you would pay taxes on the gain. But if you donate it to the charity's not going to pay taxes on the gain, and you're not.
Because they're a nonprofit.
Because they're a nonprofit.
You give it away, so you get the deduction based on the full market value of that security. Now,
if you're itemizing. Now, does it ever make sense to give a stock that you have a loss in? I don't know of any scenario where that makes sense, because you can sell it, claim the loss, and then donate the cash. Mm-hmm. So you're getting the loss on the security, which you can then use to offset capital gains or your ordinary income. And if you are itemizing, you can deduct the actual value of the cash gift.
Mm-hmm.
And so you're getting a double tax benefit by selling it and donating the cash.
So anybody that's been investing for any period of time that owns stocks, particularly tech stocks, you've got big gains in those stocks. Those are really prime for making a security donation to the charity. Now, what typically happens, the mechanics of that, is a charity probably has their own brokerage account. You can call your broker and have the securities electronically transferred to the charity's account. The charity then will value the security on the day the security transferred, and it's basically an average between the opening price and the closing price for the day. they'll send you a letter that says the value of that donation was X number of dollars. The charity's probably going to turn around and sell it immediately because they're not really in the business of speculating on where that stock price goes. And then you get the deduction, the charity's happy, everybody's happy.
Right.
But don't sell it and give them cash. That happens sometimes because then that doesn't work that way. You got to give the security.
Right. And now we talked about, for many people who aren't itemizing their deductions anymore, who can only take the standard deduction, there is still benefit in that. But if you sell it and then give cash, there is no tax benefit to that because you're going to pay the capital gains tax. And since you're not itemizing, you're not going to get the deduction from the gift itself, the value of the cash that you give. So to give it to the charity, now you don't have to pay the capital gains on that, right? And even though you're not getting the deduction on the value, you're avoiding the capital gain. So
Archie,
there is some benefit to that.
Let's pivot to this other concept, which I love. So if we have this big standard deduction now, which is due to sunset at the end of 2025, so if it sunsets, it's going to go back to the old number one. But if we have this big standard deduction and we have gain securities, stocks that are worth a lot more than we paid for them, I love the concept of making a large donation to a donor-advised fund so that in this year or a particular year, your donation is greater than the standard deduction. You take the deduction, and then once it's in the donor-advised fund, then you can pay that out into the future anytime you want. So let's say you give $10,000 a year to your church, but your itemized deductions are below the standard, so you're not getting a tax benefit. What if you give 10 years worth of donations from your brokerage account to the donor advised fund, get that massive tax deduction, and then pay it to the church once a year?
Yeah, $10,000 a year.
Yeah, you're pre-funding
those. Sorry, go ahead.
You're pre-funding that future obligation to your charity, but you're maximizing your tax benefit.
Yeah. And the church continues to get that regular income that they rely on that's predictable from their donor, which is you. But yeah, another way to do that, and that's, we talked about in a previous episode, bunching your deductions. So, like front loading into 1 year a bunch of, and that's a great way to do it. Probably the best way to do it is the donor advised fund.
If this is interesting to you, if you're watching this or listening, give us a call, shoot us a text at 304-876-2619. If you have any questions, happy to help out.
Yeah, absolutely. And let's talk about, I don't know that we'll have time, but this topic had a lot more meat on the bone than we expected. I don't know that we'll have time for the last couple that are a little bit more niche or niche, depending on how you like to say it. But let's talk about one more really important method of giving, and that's qualified charitable distributions. Now, qualified charitable distributions are another way to give that if you're not able to itemize deductions right now, and you can only take the standard, qualified charitable distributions are one of the best tools that you have in your toolkit to donate to your charities and still get a tax benefit. Now, there's qualifications. You have to be at least 70 and a half years old. So it starts a little bit before you're required to take your required distributions.
Can you do it if you're 70 3/4?
Yes.
Okay.
Yeah.
Just checking.
If you're keeping track of your age that way. Yeah.
I'm actually 1,437,000 months old.
But anyway, so the way that this works is you make a donation directly from your IRA. You never take possession of the money. It goes from the IRA to the charity. It's a check written out to the charity most often. And the way that works is that which normally an IRA distribution is fully taxable, if it's all pre-tax money. With a qualified charitable distribution, it's not taxable at all. So you're pulling money out that would be income that you'd pay tax on, but you're not paying any tax on it. So it's a way to to give and still receive a real significant tax benefit, even though you can't itemize.
It also has, we talked about torpedoes in the last episode, tax torpedoes for retirees. It also has the added benefit of reducing your taxable income, which impacts the rate at which your Social Security may be taxed. Mm-hmm. It also impacts the amount that you pay for Medicare Parts B and D premium. So right. All of these things are interconnected. You need an integrated approach to it, but it can be pretty powerful.
Yeah, especially when you actually hit required minimum distribution age.
Yeah.
All of a sudden, your income is kind of out of your control unless you shift your giving strategy and say, all right, well, I'm going to give directly from my IRA and take some of that RMD that I'm required to take, and I'm not going to pay tax on it because, my favorite charities are going to get it. So, I think that pretty much is about all the time that we have. If you have questions about this,
or if your charity, if your favorite charity needs help with this, needs to talk to somebody, we're happy to pitch in.
Yeah, we've got the number on the screen here, call or text.
That's 304-876-2619 for listeners.
Yep. And we hope that you subscribe and share with your family and friends. Leave us a comment with your thoughts. Hit the like button, and we'll look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.